Bond. It is one of the safest investment instruments in the investment world. But what happens when it stops being safe? Well, it's not just Sabah Dynamic. There are also other companies like Evergrande that have their investors on the edge, as the losses could amount up to trillions of dollars and possibly lead to a global financial pandemic. How did this went from a safe investment to a ticking time bomb? Bond goes way back. The first bond that was recorded in history was in 2400 BC. This particular bond guaranteed the payment of grains by the principal, and surety bond guaranteed reimbursement if the principal failed to make payment. Fast forwarding to today, investors would loan their money to institutions in the form of bonds. The institutions would use the money to fund their operations. In return, they would pay the investors a fixed rate of return. This is known as the coupon rate, which is paid to the investors over a specific time frame. Once this time frame expires, the institution will pay the principal or the par amount to the investors in full. And that is called a maturity date. That is the basic premise of a bond. A promise to repay a debt in a specific time frame. And in between, giving the investors a promised income stream. That's why many investors like it, because it provides a predictable income stream. On top of that, it helps them to offset the volatility of stock holdings. But haven't you heard of this? A promise is only as good as its maker. So yes, not all bonds are created equal. Not this bond lah. So, the point is, the issuer of the bond means everything. Generally, there are three categories of bond issuers in the market. The first category of issuer is government. Government needs to raise money to run their country. That's why there's government bond. Collectively, government bonds are also known as treasuries. But more specifically, bonds issued by government that have a maturity below 1 year are known as bills. And bonds with a maturity between 1 to 10 years are known as notes. And those with a maturity above 10 years are known as bonds. But regardless, they are collectively called treasuries. Government bonds are usually the safest bond in the market since it's guaranteed by government. What are the risks that a country will default, right? But seriously, generally it's the safest bond out there. But having the safest means the returns are also generally the lowest. The second category of issuer is agency. This means government-affiliated organization. Well, remember the infamous 1MDB? That is an example of an agency. For agency to run its operation, they also need to raise funds. So issuing bond is one of the most common ways to get that done. Although agency bonds are government-sponsored, but it's not as fully guaranteed like a government bond, so it is still slightly riskier than government bonds. The third category of issuer is corporations. Corporate bonds are issued by different types of companies. They are naturally the riskiest of the three. Well, it's not uncommon to see companies going bankrupt, right? That is why company bonds tend to be compensated with a higher return as compared to government and agency issued bonds. Naturally, corporation who has a good financial position will have a lower return on their bonds. But those corporations with a riskier financial position will have a higher return. That's no free lunch, right? High risk, high return. There are some bonds that can give you up to 2000% yield to maturity per annum, which means your return if you hold this bond until its maturity date. Yes, you are not reading it wrong. That's 2000%. Let us look at Sabah Dynamic. For Sabah Dynamic, their bond is actually called Sukuk, which is the Sharia compliant version of a bond. Each unit of Sukuk issued was worth $100. This means by maturity date, each unit of Sukuk that's held by the investor will be given $100. On top of that payment during the maturity, there is also an annual coupon rate of 6.3%. which means investors who are holding their Sukuk will be given $6.30 for each unit of Sukuk that they are holding. Previously, when Sabah Dynamic was known as a company that was fast expanding and it was gaining a lot of public confidence, if you want to buy a Sabah Dynamic Sukuk in the secondary bond market, investors actually have to pay a premium for their Sukuk. This means that the price of their Sukuk in the aftermarket is often sold above the original issued price, which means more than $100 for each unit of sukuk. But when the whole audit issue blew open, investors lost confidence and the value of their sukuk in the secondary market just crashed. Today, if you want to buy Sabah Dynamic sukuk from the secondary market, you only need to pay less than $30 for one unit of sukuk. Since investors have very little confidence that they are able to meet its payment during maturity. But if Sabah Dynamic managed to pay you back in full on its maturity date, which is 9th of May 2022, you will get back $100, which is more than 300% return for you in a very short period of time. But you gotta be very speculative to make such investment decisions.
Better watch out, you better not cry.
Don't think that all bonds are safe and great. Next time when someone comes to you with a bond investment and tell you,
hey, this is a bond, very safe and got very high return.
it doesn't mean that it's safe and great, okay? If you want to invest in bond, it's very important for you to do research and learn about it before making a decision. And to do that research, you can use Bondsupermart. They are Asia's leading portal for bond research. What I like about them is this. They are one of the best education and research sites when it comes to the topic of bonds in the internet. There you can find all the information you need for over 2,000 bonds in the form of articles, podcasts, and video. On top of that, there are also tools such as Bond Selector, Portfolio Builder, and even a bond calculator. With a treasure trove of tools on the site, you can use it to choose the right investment bond for yourself. And the best part is, it's free! So go ahead and check them out. I've attached a link in the description below. Bond is a great investment instrument, especially if you're looking for an investment that can provide you with a stable income in the future. Imagine, regardless of how the market is performing, you will get paid every year. That is why ultra-rich people traditionally like to use bond in their investment portfolio, because their concern is mostly wealth preservation rather than wealth expansion. Nonetheless, even if your priority is in growing wealth, bond actually makes very good investment to buffer your risk. That is why most investment funds will have at least some bond in their investment portfolio. So the big question is here, how do we invest in bond? What we must know before investing in it? As we mentioned earlier, it is very important to know who is the issuer of the bond. Is it a government, an agency, or corporation? Generally, government bonds have lower coupon rate, usually 1 to 3%, which means the return is lower. But if you want to invest in corporate bonds, the return can be pretty decent. Sometimes it can range up to 10% per year. So this really depends on your risk appetite when you're investing in bond. When you're thinking about investing in a bond, one thing you need to know that is very important other than the issuer and the coupon rate, you need to know the yield that you're getting based on the current price of the bond. Although the coupon rate of a bond is fixed, you actually can get a higher return when you buy a bond at a lower than issued price. For example, if a bond was issued at the price of $100 and the annual coupon rate is 3.75%, this means that the bondholder will be receiving $3.75 every year. But when the bondholder decides to sell this bond in the secondary market, they may sell it at a different price from the issued price, right? So let's say maybe the bondholder is facing some financial issues and he wants to sell his bond fast. So he decided to sell it at a lower price on the secondary market, like $90. Then whoever who buys it at that price is actually getting a good deal, because the new bondholder will still receive $3.75 every year, although its cost is just $90. This means his actual return is actually 4.17% instead of 3.75% as stated in the coupon rate. So if you manage to find a good deal in the secondary bond market, it can provide you with pretty good returns. One more thing is this: if you're interested in investing into corporate bonds, I personally would prefer to invest in asset-backed ones, which means that these bonds are actually backed by assets. Generally, this kind of bonds would offer more protection than a general corporate bond. But having said that, you need to know the quality of the asset that's backing the bonds in order to really assess the risk. Anyway, if you want to find out which are the bonds that are asset-backed, you can simply select the option in the Bond Selector tool. Then they will show you a list of bonds that are asset-backed. Remember, bond investment is great, but not all bonds are created equal. Make sure you find the right bond. Hey, not this bond lah.